Welcome to Module 3B, Additional Income. In this module, we'll be covering Schedule 1. By the end of this module, you will be able to understand the different sources of income that are reported on Schedule 1, understand the types of additional income that are out of scope for VITA. In this module, we'll cover additional income, taxable refunds, alimony received, other gains or losses, rental income, farm income, unemployment compensation, other income. We'll recap and have a knowledge check. Additional income found in the Form 1040, line 7A. If the taxpayer has additional income, a Schedule 1 must be completed. Don't worry, the tax software that you are using will automatically add Schedule 1 if you indicate there is additional income. The additional income reported on Schedule 1 includes taxable refunds, credits, or offsets of state and local income taxes, alimony, business income or loss, other gains or losses, rental real estate, royalties, partnerships, S corporations, trusts, etc., farm income, unemployment compensation, and other income. The total of all this additional income will be reported on Schedule 1, and that is transferred to line 6 on the Form 1040. As you can see, here's line 7A for other income from the Schedule 1. Here you can see a slide of the Schedule 1. Now we'll talk about taxable refunds, credits, offsets of state and local income taxes. This is Schedule 1, line 1. Taxable refunds, credits, or offsets of state and local income taxes. This is meant for taxpayers who received a state or local income tax refund. Those taxpayers who itemized deductions in the previous years and received a tax benefit from deducting state or local income taxes may have to report part or all of their refund as income. Generally, these taxpayers receive Form 1099-G that reports their state and local tax refund. In some cases, state income tax refunds are taxable on the federal return. The refund becomes taxable if it produced a tax benefit in the previous year. The software will guide you through the process. When considering state tax refunds, when a taxpayer itemizes their deductions, the difference between their itemized deductions and the standard deduction must be considered to determine the benefit and therefore the portion of the refund that is taxable. When a taxpayer received a state income tax refund and took income tax as an itemized deduction in the prior year, the preparer needs a copy of the prior year return to determine how much is taxable. If the taxpayer did not itemize deductions on the prior year return or did not receive a state income tax refund, there's no need to report any of the state income tax refund as income on the federal return. Now we'll talk about alimony received, which is line 2A on the Schedule 1. Under the new tax law, alimony, which is the court-ordered provision for a spouse after separation or divorce, is no longer reportable or deductible for divorce decrees that are initiated or revised after December 31st, 2018. If the divorce decree was initiated before December 31st, 2018, the receiving spouse reports the amount received on line 11 of the Schedule 1, and the paying spouse is allowed to deduct the amount paid. Note, you'll need to input the date of the divorce decree on the 1040. Now we'll talk about other gains or losses, which is line 4 of the Schedule 1. Note, preparing these returns, which require a Form 4797, is out of scope for VITA. In order to kick in the Form 4797, a taxpayer must have sold or exchanged assets used in a trade or business. Next, we'll talk about rental real estate, royalties, partnerships, S corporations, trusts, etc., which is on line 5 of the Schedule 1. As noted prior, preparing a return with these types of income is out of scope for VITA. So if a taxpayer receives money from renting out property receiving royalties, income from partnerships, S corporations, or a trust, it's required to be reported as income, and therefore these taxpayers are out of scope for the VITA program. Next, we'll talk about farm income or loss, line 6 of the Schedule 1. As was the case with the previous two lines, farm income is out of scope for VITA. Next, we'll talk about unemployment compensation, which is line 7 of the Schedule 1. Unemployment compensation is the money paid to unemployed workers who lost their jobs due to layoffs or retrenchment, which is the reduction of costs or spending in response to economic difficulty. These taxpayers would receive a Form 1099-G. Box 1 shows the total unemployment compensation paid to the taxpayer. And be sure to enter any federal or state income tax withholding in box 4. Next, we'll talk about other income, which is line 8 of the Schedule 1. Other income is the income that the taxpayer received in the year that does not have a place somewhere else on their return. Individuals who received a 1099 miscellaneous with income in box 3 should report this as other income on line 8 of the Form 1040 Schedule 1. Line 8 may also include other items that are not included in the 1099 miscellaneous, such as non-business debt cancellation from Form 1099-C. Note, this requires an advanced certification. Coverdell Education Savings Accounts or 529 distributions from Form 1099-Q. Gambling winnings from Form W2G. And you can see in the next module for more information on other income in the Form 1099 miscellaneous. To recap, there are many types of income reported on the Form 1040, but several types are reported on the following lines in Schedule 1, and these are divided into basic and advanced and out of scope levels. Feel free to rewind this recording at any point to see what you may have missed. Up next, we'll be talking about Module 3C, Miscellaneous Income.